Good morning. This is Dylan Jovenet with Behind the Markets. Happy Monday. Today is Monday, July 6th. I hope you had a wonderful 4th of July weekend with your family. I hope you didn't eat too much or drink too much beer, and you're here and you're ready to go. You're ready to continue. This is my last week before my vacation. I talked about this for a while, but I'm hitting the road with the fam. Going to be America's 250th birthday. We are touring. We're going to be driving all around America. I want to show my kids how beautiful this country is and a lot of the middle parts of the country we don't usually go to. So I'm really looking forward to that. Anyway, today I'd like to talk about a note out from Goldman Sachs. Goldman Sachs out with a couple of interesting notes lately. This one talks about they're advising investors to capitalize on the recent tech sell-off by buying hyperscalers. They're saying hyperscalers look cheap coming into earnings seasons, which kind of kicks off the 13th, I guess. Yeah, second week. So kick off the 13th, the big earnings season. So Goldman Sachs is saying hyperscalers look good, and I actually happen to agree with them. The hyperscaler index that they track is down 17% since June 1st. So those of you who own Amazon, Microsoft, Google, Meta, Oracle, hyperscalers, you've been feeling pain. We've all been feeling that bit of pain. And we've talked about the fundamental problem here. Investors are saying, look, you guys are spending a lot of money, and it's not clear what the return on that investment looks like. There's a lot of fatigue with these people. I mean, my goodness, everyone's just kind of tired when you think about why these stocks are they're just like deflating. They're not really just being hammered. They're just kind of deflating because it's like a tale of two cities. These companies are spending a lot of money on CapEx, capital spending, data centers and chips and all the software, all the things, building up that 5-layer cake that we talk about for AI. They're building a full stack, as we call it. Remember, the 5-layer cake of AI: chips, infrastructure, data centers, AI factories, models, the models themselves, Claude, etc., ChatGPT, Grok, the application layer, which is where value will be extracted mostly, and the energy layer, which is, of course, the foundation layer. Remember, that's the 5-layer cake, and all these people are trying to build that stack up or get access and spending tremendous amounts of money to make sure that they have access to all of those critical pieces of the stack. But one thing that I've seen a lot of folks do now is they're saying, how do we turn these AI tools into actually applications that help people? So you see Microsoft, who I'm going to actually talk about a little bit tomorrow. Microsoft is actually doing a bang-up job talking about how they're going to be moving people into customers. Part of their company, they're building a new unit that is going to help their customers identify ways to use AI, which, by the way, really puts pressure on the Claude models and the ChatGPT models in terms of pricing power. It really starts to commoditize those companies, which is very, very interesting. So anyway, Goldman Sachs, in their note, they point out this great divergence, this kind of earnings for all of these companies that we've talked about. They've continued to climb steadily, but their stock prices just keep going down. Again, that is because of this capital spending. When is it going to stop? You get the sense that if they stop spending on this stuff immediately, their stock prices would just double immediately, right? You just get that sense. But the good news is hyperscaler valuations are trading at lows similar to last year's so-called Liberation Day, and also the geopolitical lows we saw earlier this year, which is really the two critical lows of this bull market, the so-called Liberation Day lows last year, and then the geopolitical lows that we saw beginning of the Iran war. Seems like when you get to those lows, big investors come in and say, okay, they're just giving this thing away. And I think to myself about Meta. Meta irritates me in a lot of ways. I mean, this guy Zuckerberg, he's brilliant, obviously, but he's irritating because it's like you got to put out a more clear plan. And it looks like they're really starting to focus on that. It looks like the kid said to himself, look, I know I need that full 5-layer stack, period. And we're going to figure out how we're going to monetize this. but with 1 billion people looking at our news feed every day in Facebook and Instagram and WhatsApp, we're going to figure out a way to monetize the heck out of this technology. It looks like they're kind of saying that, but it's costing a lot of money. So yes, the Tale of Two Cities, while they're spending a lot of money on capital expenditures, their earnings are doing great. You can see that the AI investments that they're actually making in serving ads on their networks, on Facebook, on Instagram, and WhatsApp, it's kicking their earnings with. Their earnings are just soaring. And you know something, even with my own exposure to social media, I can tell the ads are getting faster and more targeted, which again, remember the key about business. Success in warfare is all about speed. Success in business is all about speed too. So the companies here that are best able to monetize their customers are the fastest in the shortest period of time are going to win. Those are the companies going to win. So look, Microsoft looks cheap, Amazon, Google, the hyperscalers, Oracle. Well, Oracle is something that I personally would stay away from on this list. On this list of Amazon, Microsoft, Google, Meta, and Oracle, one where I just, not a fan of the economics of that business. It's very slower business, not a fan. Whereas all these other ones have relationships with consumers, dominant franchises with consumers, which are all very, very different, and corporations. When you think of like Amazon, their web business, or Microsoft's cloud business, or Google's cloud business. So that gives us a lot more safety when buying dominant franchises. Consumer franchises tend to earn higher returns on capital, have higher gross margins, give us a lot more safety. Anyway, those are stocks that I'm looking at. I bought a little bit more Microsoft. I nibbled at these prices. They're crazy. I'm already in the other ones pretty strong, and they're up from where I bought them. But here we are. I think Microsoft looks great, and Meta looks like great too, but Microsoft actually looks like it's stupid cheap. Anyway, that's all I have for you. Have a wonderful day. I will speak to you tomorrow.